He calls himself the skeptical strategist. Nomura's Bob Janjuah called the financial crisis and the rebound, and he's with me here in London for the hour. Lots to talk about, of course. The collapse of the Irish government, the European debt crisis, the global appetite for risk. But first with Bob, let's do what he does so well. A market call. Bob, are you Bob the Bull or Bob the Bear today?
Tactically bearish.
Tactically bearish.
2 to 3 month view. I think we saw the decent run up we were looking for from mid-November till now. I think it's now time to put
We're
the
talking
risk
about stocks, of course. S&P 500 at 1295.
and commodities up, and but we're now looking for a reversal of the post-Jackson Hole risk-on or inflation trade.
Down to where?
10%, I think, for now.
A 10% correction?
For now. And then I think there's a lot of pitfalls, which we're going to talk about later, which I think,
absolutely,
depending on how we navigate those, it could be worse, could be better.
Before the break, you were telling us that it is time, perhaps, for a 10% correction in U.S. equities. We hit 1295. We're now at 1283. Let's pull back for a moment and talk about some of the big themes driving the markets over the course of 2011. What underlies this skeptical view that you have of the potential for U.S. stocks? And let's bring in perhaps some other asset classes. What's going to happen to commodities?
Sure.
What's going to happen to treasuries? What's going to happen to credit? But mainly, what are the themes? What's influencing your thinking?
Well, look, I think right now three themes seem to be in sort of everyone's focus. One, is Asia going to slow down? If so, when and how? Will it be hard or soft? Debate. And does that have global implications? We think it does. Right? Particularly on the basis that...
I can think of a few people who might agree with you.
Well, we've had a lot of people tell us Asia doesn't matter. That's
really
a surprise, right? And a worry. Number two, is Europe closer to the end game in terms of fixing its problems or not? And I think in that context, are we going to need another crisis before we get the solution? And perhaps is Ireland that crisis? We can debate that. But I think number three, and I think the thing that's considered to be the least risky issue in the market, is the US recovery. Is it sustainable? Is it going to deepen and broaden into the domestic economy, which we think it has to if it's going to be sustainable? Or is this a redux of last year where, let me take you back a year, a lot of people were talking about Fed exits and rate hikes by the Fed. A couple months later, something completely different happened. Okay, so blend together these views. Sure. And where do they take you? What assets do you feel like you want to be in? Right. So I think what we're seeing and what we think makes sense is a reallocation out of EM into DM, developed markets. Okay. That sort of makes sense. I think. But into what? Well, right. You've got some choices, right? You either want government debt, you want credit, right, corporate debt, or perhaps I think the other want equities. If you're really feeling risky. The other big thing we've seen is a flow out of fixed income and equities into out of fixed income and credit, into equities. Now, the issue for me is this: if you believe the U.S. and the Western economies are about to kick off on a long leg of sustained growth, really the only thing you really want to own are U.S. financials. And perhaps European financials for that matter as well. The financials have been left behind over the course of 2010. If we're going to have genuine domestic-led recoveries in these economies, the financial sector is going to be at the middle of all of that. Okay, but where do you stand? You're bearish in the short term, but it sounds as though you're somewhat bullish medium term. No, I actually think that we're going to have a deeper and harder slowdown in Asia than people think. I do think the European situation is closer to the end game, but I think a crisis is possibly going to be required to get us over the line. My biggest doubt is on the US recovery. And I'm going to suggest that actually this year will end up like last year, where in Q2, Q3, and as the year unfolds, the growth story weakens. And then, much like last year, we're going to be looking for QE3. Oh, boy. And my concern this time around is that the hurdle rate for more policy, fiscal or monetary, is much higher. I didn't know who we were going to get this morning when Bob came in. Bob the Bear or Bob the Bull? Well, Bob is definitely feeling a little bearish this morning, telling us we may see a 10% correction down in U.S. stocks over the next 3 months. And Bob, one of the reasons, as you articulated just a few moments ago, are the lingering questions about the euro. What's going to happen in the Eurozone over the weekend? We see the Irish government collapse. Yeah. Is that the crisis, as you say, we may need to see first before a solution? Well, look, one of our key risks, and one of the reasons we wanted to be risk-off over the next couple of months, was the Irish election. I think one of the things that we have been and are most concerned about is the prospects that Sinn Féin could form a reasonably large block of the new parliament, with Mr. Jerry Adams standing and his colleagues standing around the Republic. And, I'm not going to suggest that Sinn Féin are going to run Ireland, but I think there's an awfully big push in the run-up to elections, which has now, I think, been hastened somewhat by what's happened. of really sort of selling this sort of no message to Brussels.
And is that a warning sign to, say, Portugal and perhaps Spain and maybe other countries that if you take political risks like Prime Minister Cowen has taken, it may end up creating serious political distress. And with political distress, you can't really get anything done.
Sure. Well, look, I mean, we've got a version of that going on in some of the emerging markets with food and one or two high-profile, I think, events going on there. I think in the Eurozone, I think Kevin, my colleague Kevin Gaynor, who worked at the Commission when it was all being set up, he said to me a number of times that the risk was always that if we end up in a situation like we have now, political extremists get it. And I think this is the tension that we're concerned about. And I guess the Sinn Féin push in Ireland is to say no to Brussels, is to ask the banks to default or not guarantee the banks, because this is really benefiting foreigners, and to really, I think, put the national interest first, which may be misguided, but it's a fear for the market. And
at the end of the day, what happens to the euro? Several months ago, you told me you could see the euro going to parity. You still think that's possible?
Well, look, I think it's very clear now for me that the euro has really two choices. It either is going to become the world's next reserve currency, or it's not. And I think the resolution of the debt problem in the periphery, the banking sector, the required recapitalisation of the European banking system, if we can get that done properly, the euro wins. If we don't get that done properly, I worry.
And your gut feeling?
I'm actually a little bit more optimistic today than I was 2 months ago. I think there's been a push towards realising this is a solvency problem, not a liquidity problem. There's a push to clean up the ECB again. And I think there's a realisation that fiscal measures and equity are going to be needed as opposed to just money printing.
Bob, why be skeptical of the U.S. economy right now? Think about it, right? We've got phenomenal earnings growth. Corporate balance sheets are as strong as they've ever been. And CEOs seem to be brimming with renewed confidence. All of a sudden, we see all kinds of M&A activity. That usually suggests that, at least from a confidence standpoint, from an optimism standpoint, things are looking up.
Yeah, a couple of things. Look, first of all, we're not talking about negative growth in the US, even in my world. I think we're talking about sub-trend. So that would be, Q on Q annualized, coming sub-2 as the year unfolds. Second point, take you back a year. Pretty much everyone was telling you the Fed was going to hike, and we were talking about exit policies. We ended up having to do QE2. And we talked about this earlier. Where would the S&P have ended last year?
Yeah, where would the S&P 500 have ended absent the Fed printing all kinds of money?
Well, I'm going to suggest pretty confidently closer to 1,000 than to 1,250.
And we almost hit 1,300 just the other day.
Sure. So I think, we were looking for this
run-up.
So
the Fed hadn't been in the market, so effectively the Fed was the bid. I mean, if the Fed hadn't been in the market flooding investors with liquidity, giving them cash to buy risk assets, the S&P would have declined. Yeah,
it would have done what it was doing anyway over the belly of last year. And I think for this year, we can talk about a bunch of stuff, but if I look at things, the housing market seems to be not improving. I think the fiscal boost is sort of done and played through in terms of the immediate impact on the economy. The municipal state problem, so I think is a much bigger drag on the economy than any fiscal boost. The increase in oil, food and energy prices is, I think, an enormous tax on the US consumer. And I think in terms of the profits, look, I mean, the savings ratio in the consumer sector has run down. Is that sustainable? I don't know.
So, okay, so if we were going to see a sustained return to, say, 3.5% annual GDP growth, what would you need to see first?
Jobs.
Jobs. Goes without saying.
Yeah. Simple. I think, in a world where leverage is not going to drive growth, it has to be real incomes. And on the basis that earnings increases are sort of very modest, it has to be the aggregate number of people employed. I don't see any evidence of that yet, right? If you look at the numbers of people employed in the US economy, it's down significantly from the peaks.
With about a minute to go before we hit another commercial break, Bob, what about the Asian factor? How much could Asia, a decline in Asian economic growth, rob the US of some of that potential?
Well, look. Over the last 18 months, 70% of global marginal demand came from two countries in Asia, China, India. If they are going to slow down by a third, which is the soft landing call, somebody's got to fill the gap. Otherwise, there's a hole.
And if the U.S. just doesn't have jobs, the U.S. can't fill the gap.
Right.
Bob, you've said three surprising things. Number one, we may see a 10% correction in U.S. stocks over the next 3 months or so. Number two, the calm in European markets may be for real. The EU is getting closer to resolving the sovereign debt crisis. And third, U.S. growth may not be for real. We may see GDP growth slip back to 2% later this year. What I want to talk about now is where are the biggest risks? You look across the globe, what do people need to be watching out for? What are the warning signs?
Right. So with the caveat that I'm looking for a tactical sell-off, the immediate risk, I think, is a melt-up in markets. Why? Because the market...
More of the reflation trade.
More of the reflation trade, particularly if Asia refuses to take meaningful action to slow down.
And that's because we'd be building a bubble.
Well, sure, right? And I think in that context, I think people get even more confident of the US story as well. So I think that's risk one. But
deceptively confident,
yes,
right? Okay.
Yes. I think beyond that, I think for me, the risk spotting, I think really it's around inflation getting out of control in Southeast Asia and other parts of the emerging markets. Jobs in the US, jobs. And I know we have an administration who's very keen to create jobs, but their job targets have been woefully poor today, right? Now that may change. And then I think the other very big risk out there, which is a question we've been asked more and more of recently, is the bond market, bull market over? Are we entering a new bear market? And in this context, at what point does the rise in bond yields, if that is indeed the case, really negate and reverse the taper trade?
All right, so bonds are a flashpoint, and we need to keep our eyes closely focused on what the Chinese do about inflation. Bob Janjuah of Nomura was here in London, my guest for the entire hour.